Cattle are at record prices right now, but the bigger story this afternoon is that agriculture keeps getting squeezed from every direction at the same time. Higher input costs, tighter regulation, disease pressure, and markets that still don't fully trust this rally. This is Boots and Bushels, your daily look at the markets that feed America. There's one story floating around over the weekend that honestly says a lot about agriculture right now, even though it sounds like something out of a movie. Researchers are studying cattle that were abandoned on Amsterdam Island more than 100 years ago, a remote island in the southern Indian Ocean. And somehow those cattle adapted, survived, and developed genetics researchers didn't expect. No feed wagon, no modern management, no fancy setup, just survival. And honestly, that's probably why the story is catching attention with producers right now, because agriculture has felt a lot like survival mode lately. Margins are tight, inputs stay expensive, markets swing on headlines every few hours, and now producers are trying to sort through another round of government policy changes while cattle markets continue pushing historic territory. We'll start with cattle because cash cattle continue holding near record levels. Futures have stayed supported because supplies are still tight, weights have not exploded higher, and demand has stayed stronger than a lot of traders expected heading into spring. But even with cattle holding together, there's still hesitation underneath this market because feeders know how fast momentum can change once placements start shifting or consumers finally push back against beef prices. And right now, there's another issue building behind the scenes, the DOJ and USDA continuing pressure on the big beef packers. There's renewed focus on market concentration and pricing transparency again after more discussion about antitrust investigations and data sharing practices inside the cattle industry. Producers have heard versions of this story before, but what matters here is timing. You've got record cattle prices at the same moment regulators are increasing pressure on the packing side of the industry. That creates uncertainty nobody fully knows how to price yet. Because if Washington starts changing rules around reporting, competition, or procurement structures, it could eventually affect margins all the way through the chain. At the same time, input pressure still isn't going away. Fertilizer prices continue climbing after recent instability tied to energy markets and Middle East tension. Every time crude oil starts moving aggressively, agriculture immediately starts paying attention because producers know it rarely stops at diesel. Fertilizer freight, chemical cost, drying cost, eventually the pressure spreads across the entire operation. And that's where grain markets still look nervous. Corn and soybeans have tried stabilizing after recent weakness, but the trade still feels uncomfortable. One day crude oil rallies and grains follow. The next day outside markets back off and grain traders lose confidence again. It doesn't feel like a market with strong conviction right now. It feels like a market waiting for the next major headline. Then you add in the Farm Bill situation. The House pushing the 2026 Farm Bill forward sounds positive on the surface because producers want certainty. But there's already concern about SNAP funding fights, pesticide language, and how much actual protection producers will end up getting once negotiations move deeper into the Senate. And farmers have seen this movie before too. Big promises early, complicated negotiations later, then eventually everybody tries to figure out what actually changed. There's also growing concern about regulations tied to wetlands and drainage compliance after USDA discussions around certified wetland reviews before land changes. That may not sound dramatic sitting in Washington, but producers immediately understand what those kinds of rules can mean on the ground. More paperwork, more delays, and more uncertainty around what can or cannot be done with acreage. Then there's the disease side of agriculture still hanging over the industry. Bird flu concerns have not completely disappeared. Dairy producers are still watching that closely. And globally, agriculture keeps getting reminded how vulnerable supply chains really are anytime disease, trade problems, or transportation disruptions show up all at once. Which brings this entire market back to the bigger issue. Agriculture right now doesn't have one clean story. Cattle are historically high, inputs are expensive, government regulation is increasing, grains are struggling to regain confidence, and producers are trying to protect margins while the market keeps changing tone every few days. That's why this feels so tense underneath the surface, even on green days, because nobody fully trusts how stable any of this really is yet. And a quick reminder, if you want daily updates on the markets that feed America without all the extra noise, go ahead and like and subscribe. I do this every day, focusing on what actually matters to producers and rural America. And honestly, that Amsterdam Island cattle story might connect to producers more than people realize, because agriculture has always been about adaptation. Markets change, weather changes, regulations change, costs change, and producers keep figuring out how to survive anyway. That doesn't mean the pressure is easy right now. It just means agriculture has been forced to adapt before. And that's exactly what this market feels like again heading into this week. Starting tonight, the weather pattern looks active enough that producers across the plains and Midwest are going to need to pay attention again, especially anybody trying to finish planting, move cattle, or get hay work started. The biggest issue tonight into Tuesday is another round of thunderstorms developing from parts of Kansas and Oklahoma up through Missouri, Iowa, and parts of Illinois. Some of those storms could bring large hail, damaging winds, and locally heavy rain. The concern here is not just the storms themselves, it's repeated rainfall over already wet areas. Rain chances stay elevated through Missouri, Iowa, Illinois, Indiana, and parts of the Central Plains. Producers trying to stay ahead of the planting window may continue fighting muddy fields and narrow stretches of workable weather. Some areas could also see localized flooding if storms repeatedly track over the same ground. By Wednesday, the severe weather risk shifts a little further south and east, but storms still remain possible from the southern plains into the Mississippi Valley. Oklahoma, Arkansas, and nearby areas could see another stronger setup with hail, damaging winds, and isolated tornado potential. Cattle producers may need to watch rapid temperature swings and storm stress closely through the midweek. Thursday starts looking more split across the country. Parts of the western plains may finally start drying out a little, but sections of the eastern Midwest and Delta could continue dealing with scattered rain and softer field conditions. Meanwhile, portions of the central and southern plains continue carrying drought concerns underneath these storm systems, especially in wheat country where conditions have already been rough this season. Friday looks calmer overall for some areas, but the pattern still does not fully shut down. Temperatures should moderate in much of the Midwest, while scattered storms remain possible across the plains in the south. The bigger story by the end of the week may simply be that producers still are not getting long, uninterrupted stretches of stable weather for fieldwork in several key growing areas. And that's the frustration with this setup right now. It's not one giant nationwide weather disaster, it's constant interruption weather. Short planting windows, pop up severe storms, heavy rain in spots. That kind of pattern keeps markets nervous because it prevents the crop from settling into a clean, stable start. Corn finished Friday near 447, and that tells you the grain side is still trying to find its footing, but it hasn't fully taken control yet. Corn isn't collapsing, but it also isn't showing the kind of strength that makes producers feel like the board is ready to run. Right now, corn still feels stuck between planting progress, demand questions, and outside market pressure. Soybeans finished near 1052, and beans continue to look like the stronger side of the grain complex. Crush demand is still helping underneath the market, but beans are also running into the same problem corn is dealing with. Traders want a reason to believe this thing is more upside. Without a fresh demand story or a stronger weather concern, soybeans may hold better than corn, but they still have to prove they can break away. Chicago wheat finished near 531, and wheat is still carrying that weaker tone. It has had little rallies, but sellers keep showing up, and the market is still dealing with global competition, export pressure, and a feeling that wheat needs a bigger weather or supply scare before traders get serious again. Live cattle finished Friday near 212.90, and that's still the strongest story on the board. Cattle have backed off in spots, but this market is still sitting in historic territory. Tight supplies are still doing the heavy lifting. The risk now is not that cattle suddenly look weak. The risk is that when a market gets this high, every little shift in demand, weights, placements, or packer buying starts to matter more. Feeder cattle finished near 301.20, and that number still shows how tight the replacement side of this market really is. Feeders are carrying a lot of the strength because the supply side has not loosened up. But when feeder cattle are above $300, producers know the margin risk gets sharper. There's less room for mistakes when inputs, corn, interest, and purchase prices are all sitting high. Lean hogs finished near $100.05, and hogs are holding together better than they were earlier in the year. That market still has its own demand questions, but the board is at least showing some support. Hogs are not leading the livestock story, but they aren't being ignored either. Class 3 milk finished near 1860, and dairy is still in that range where producers are watching margins closely. Milk prices are not terrible, but they're not giving a lot of cushion either, especially with feed, labor, and operating costs still elevated. If crude starts pushing higher again, that pressure does not stay isolated very long. So the Friday close gave us a split picture. Cattle are still historically strong. Feeder's still expensive. Grains are trying to stabilize, but they have not fully convinced the market. Milk is holding, but margins are still tight. And crude oil is still sitting there as the outside market risk that can change the cost side quickly. That's the setup heading into the week. Cattle still have strength, grains still need a reason, and producers are still trying to protect margins in a market that can shift fast. That's Boots and Bushels for Monday, May 11th. I'll be back here again tomorrow with more ag updates.